Hi, I'm Jai Merchandani, CIO and founder of ELM Responsible Investments. And today we're looking at the companies powering the clean energy transition and leading the technologies that will shape our future. The global shift towards decarbonization is one of the largest capital reallocations in modern history. But from an investor's perspective, this transition allows them to participate in businesses making a positive impact on society more broadly, while investing in a structural growth opportunity. An additional and often underappreciated catalyst is energy security. Geopolitical instability, including recent developments involving Iran, has highlighted the vulnerability of global oil supply. A prolonged period of elevated oil prices could act as a tipping point for decarbonization, particularly in regions where fuel costs are significant. At ELM Responsible Investments, we invest in the climate and clean energy theme not by chasing labels like green or sustainable, but by applying the same disciplined process that underpins our broader investment framework. Across the funds, we look for companies with durable growth drivers, those with competitive advantages and high barriers to entry, great management team and a sensible capital allocation strategy, and strong balance sheets. Within climate and clean tech, we currently focus on companies that are exposed to long-term demand growth from two main drivers. First being the electrification of transportation, the second being the AI data center build-out. These drivers are supporting demand for our holdings in renewable energy, electric vehicles, battery manufacturers, and a subset of climate and clean tech companies that are the direct beneficiaries of AI data center growth. Electrification of transportation and data center build-out both have the same first-order effect. They increase demand for electricity. Higher electricity demand then creates the need for incremental power supply. In most markets, the bulk of new capacity is coming from renewables, although not ideal, also natural gas, as well as with a smaller contribution from new nuclear, depending on the country. The electrification of transportation is a multi-decade shift that is still in its early stages. The transition began with passenger electric vehicles and is now extending into commercial trucks and delivery fleets, buses and public transport, air transport, and over time, autonomous electric fleets such as robotaxis. Electric vehicles still make up a minority of the global vehicles fleet, but their share of new sales is rising. This is being supported by better range, improving charging infrastructure, and in some regions, policy support. As electric vehicle penetration increases, electricity demand from the transport sector rises. High utilization segments such as commercial fleets and future robotaxi networks are particularly important as vehicles in these categories are used for many more hours per day than privately owned cars. This leads to higher demand for batteries, more frequent battery replacements for high mileage vehicles, and greater need for charging infrastructure and flexible grid capacity. This directly benefits our holdings in CATL and Tesla. CATL is one of the largest battery manufacturers globally. Its scale, cost, position, and chemistry expertise makes it a key supplier of batteries for both electric vehicles and stationary storage. Tesla combines EVs with an energy business that is growing in importance. Its megapack grid scale storage system are being deployed by utilities and large customers to help integrate renewables and support grid stability. We expect the electrification of transport, especially in commercial and high utilization segments, to support demand for batteries and storage for many years. The second durable driver is the build-out of AI and high-performance computing data centers. AI models and high-density computing requires significant power, cooling, and water. As these facilities scale globally, they're increasing demand across several parts of the climate and clean tech value chain. AI data centers consume large amounts of power. This is leading operators and hyperscalers to seek long-term access to reliable and, in many cases, renewable electricity. Many of the largest operators are signing power purchase agreements with renewable asset owners. Our holdings in Ørsted is an example of a company exposed to this trend. Ørsted develops, builds, and operates offshore wind farms and other renewable assets under long-term contracts. Recent management updates have highlighted growing direct partnerships with large technology companies and long-term power purchase agreements that link offshore wind projects to data center and hyperscaler demand. Amazon and Google, for example, have both contracted long-term offtake from Ørsted in the German North Sea. Furthermore, TSMC, the world's leading semiconductor manufacturer and the company that produces the chips underpinning AI infrastructure globally, has signed a 20-year agreement to purchase the entire output of their offshore wind farm in Taiwan. This provides more visibility on future cash flows and underlines the role of renewables in meeting new electricity needs. Vestas, another company that sits on the manufacturing side, It designs, manufactures, and services wind turbines globally. Recent results show a record order backlog reflecting strong demand from utilities and developers planning new wind capacity. The size and diversity of this backlog provides a sense of how much incremental renewable capacity is being planned over coming years. Together, Ørsted investors are key suppliers of the incremental low carbon generation needed to meet rising demand from both electrification of transport and data centers. High-density AI data centers generate substantial heat and use large volumes of water for cooling. This is driving demand for water treatment and recycling systems, efficient HVAC and building engineering, and Ecolab, another company in our portfolio, has a solution to the water intensity by providing water treatment and efficiency solutions for industrial and data center customers. Reducing water use and improving cooling efficiency not only is a more sustainable option, but it also lowers operating costs and helps customers meet sustainability targets. Legis, which focuses on HVAC and energy optimization built in data centers, is another company in our portfolio. Better cooling and system design can materially reduce electricity use. Data centers often require a high level of power reliability. Traditionally, this has been met with diesel backup. Over time, we expect more operators to use battery storage and other solutions to improve resilience and reduce emissions. This is another demand source for battery manufacturers such as CATL and energy storage providers such as Tesla. It also creates opportunities for companies like Bloom Energy, which provides solid oxide fuel cells that can supply reliable on-site power and, in future, may be able to run on hydrogen. Crusoe and Iron, which develops high-performance computing data centers with a focus on renewable power and efficient design, are examples of companies at this intersection of clean, sustainable business practices and the future technology. The electrification of transportation and AI-driven data center build-out are, in our view, durable trends that will play out over decades. They support demand for renewables, storage, and a set of industrial and engineering businesses that enable the transition. Our goal is to own a small number of these businesses, understand their economics in detail, and hold them through cycles as the transition unfolds. Thanks so much, and see you next time.